So you're looking to invest, you're digging into a company, and you keep seeing this three-letter acronym, PER. It's one of the most talked about numbers in finance, but honestly, it's also one of the most misunderstood. In this explainer, we're going to clear up all the confusion once and for all.
Here's the classic scenario. You find a stock with a low PER, something like an 8 or a 10, and your first thought is probably, hey, this thing looks cheap. This has to be a bargain, right? I mean, it seems totally logical.
And then you see the opposite, a stock with a PER of 40, 50, maybe even 100, and your gut reaction is to run for the hills. No way, you think. That is way too expensive. I'm not touching that with a 10-foot pole.
But what if I told you that thinking the answer to those questions is a simple yes is the single biggest mistake most investors make? Yeah, the reality is way, way more interesting than that. And that's exactly what we're going to unpack right now. So to get to the bottom of this, we've got to start with the absolute basics. What even is the PER, and what is it actually telling us about a company?
Well, PER just stands for price to earnings. And in the simplest terms, it tells you how much you're paying for every dollar of a company's profit when you buy one of its shares.
And the math behind it, it's incredibly simple. You just take the current stock price and you divide it by the company's earnings per share, or EPS. So let's say a stock costs $15 and the company earns $1 per share for the year, its PER is 15. Easy enough.
Now here is a really powerful way to think about that number. A PER of 15 literally means you are paying a price today that would take the company 15 years to earn back for you, assuming its profits stay exactly the same. All of a sudden, that abstract number feels a lot more real, doesn't it?
And once you grasp that idea, you start to see how it leads to these two giant opposing philosophies in the investing world, two camps that use the PER in completely different ways: value investing and growth investing. On one side, you have low PER stocks. This is the world of value investing. Think of it like buying a sturdy, reliable car. The focus is on safety, on mature businesses where expectations are already pretty low. Then on the other side, you have the high PER stocks. These are the growth rockets. Here, expectations are sky high, and it's all about explosive future potential.
So let's explore that first world, the world of low PER. What's the big attraction? Why do investors actively hunt for these kinds of stocks? It really all comes down to one single, powerful concept.
And that concept is called the margin of safety. You can think of this as your financial cushion. It's the gap between the price you pay for a stock and what you think the business is actually worth. And a low PER often means you're getting a much bigger cushion, a wider margin for error if you're wrong.
Here's why that matters. When you buy a stock with a really low PER, the market's expectations are already in the gutter. So a lot of the potential bad news is probably already reflected in that low price. This doesn't mean you're guaranteed to make money, but it can seriously help limit how much you lose if things go sideways. For a lot of people, the game isn't just about winning, it's about not losing.
Okay, now let's flip the coin and look at the other extreme. What are the hidden dangers lurking behind those flashy, exciting, high PER growth stocks?
The big danger of a high PER is that it leaves absolutely zero room for error. The market has priced in perfection, so the company delivers amazing growth. It does really well, but maybe just a tiny bit less than those impossible expectations. And what happens? The stock price can get absolutely hammered, even though it's still a fantastic growing business. A high PER just does not forgive anything less than perfect.
And this brings us to what might be the most critical lesson of all. A PER number, whether it's 10 or 40, is completely and utterly meaningless by itself. You have to put it in context. For example, a PE of 20 might be crazy expensive for a big, stable bank. But for a fast-growing tech company, that same PE of 20 could be an absolute bargain. Every single industry plays by a different set of rules, and what's considered normal for a PE can be wildly different from one sector to the next. And it's not even just about comparing a company to its competitors. You also have to ask, how does this company's PER today stack up against its own history? Is it trading higher or lower than it usually does? And more importantly, has the business fundamentally changed for the better or worse to justify that difference?
So, we've looked at value, we've looked at growth, and we've seen why context is king. So what's the one golden rule we need to burn into our brains when we look at a PER ratio?
Here it is. You can never, ever, ever use the PER ratio in isolation. A stock can be cheap with a PER of 30 and expensive with a PER of 10.
It all depends on the other stuff. The PER isn't the final answer, it's the starting point. It's the thing that makes you ask the right questions about a company's growth, its quality, its debt, and how much cash it's really making. And this quote just sums it all up perfectly. It's not just about the price tag. It's about how much room that price gives you to be wrong. A low PER often protects you if your thesis is off, while a high PER can punish you even if you're mostly right. So the final question you have to ask yourself is this: does this price give me a cushion for the unexpected, or does it demand that everything go perfectly?
Hey, if this explainer was useful and you finally feel like you have a solid handle on the PER ratio, do us a huge favor and hit that like button. And be sure to subscribe for more explainers on the concepts that really matter. Thanks for watching.